We got somebody else coming in? Oh, Justin, okay. Let him get in. So how's everybody? Thank you all for coming out on a Saturday. It's rainy, stormy, but it's going to be good. It's going to be good. So I hope we can bring just some value today, that you get some information that maybe you just didn't know. Buying a home can be incredibly overwhelming if you've never done it, and we're just here to kind of piece it together in little bite-sized portions of information. And it's going to be like a water hose of information, or like a fire hose. So you'll hear from me as a loan officer, you'll hear from a realtor, a title person about closing, and insurance, all those pieces that come together. So it will be a lot of information. So I encourage you to take notes. We've got some books on your table if you didn't bring paper, some pens, all of that stuff. So, and we'll try to be respectful every time. We'll try to move on through the stuff, but it's super interactive, okay? So if you've got a question, we'll obviously have some time at the end of each deal, but you can just, hey, what's that? Or just ask the question. Is that cool? All right. So just so you know, I just want to introduce myself. My name is Brandon Snyder. I know some of you guys. I met some of you this morning, but I work with Willow Bend Mortgage here in Coleman. We're located right downtown near the Catholic Church. But that's where we are. We got some former clients in here, which is good to see you too. So, but yeah, so it's awesome to be here with you guys today. So I just want to introduce you real quick just to the team that I work with, okay? So this is obviously my ugly mug. And then you got over here, you got Kelly Coffee. She's my loan partner. She pretty much can handle any question that you have. Same thing for Cameron. Both of these people help me day in, day out with the clients that I deal with, making sure their loan closes on time, they get the documentation they need, and just make sure your transactions goes as smoothly as it can. Two other pieces of this pie is Marilyn Eccles over here. She's our loan processor, and we'll talk about that loan process and what she does, sort of. And then I got Crystal Stone, who is my client relations manager, helping pretty much everything a lot post-closing. So if you have stuff that happens after the closing, she stays in touch with you, answers your questions, and all that stuff. Cool? So that's my team. So I want to cover just really what our job is like today, and just kind of how we approach what we do. So one of our main jobs is to educate you, right? Just kind of tell you, because we do this every day, right? As realtors and lenders, like this is what we live, eat, and breathe every day. So we want to bring that value to you. Another job is to know exactly what your costs are going to be. Like, so when you get down to buying a home, we work together with a real estate agent to say, okay, this is what your closing costs are going to be, and we'll cover some of that stuff. One of the biggest things is to help you avoid surprises. That's the worst thing that can happen in a real estate transaction, is have something come up that you were not prepared for. So that's our deal. So also be a resource of just information, technology, whatever that is. And everybody that comes here today, I will, if on that registration sheet, did they fill out their cell phone number on there? Anyway, yes. If they did, if I got everybody's, I'll text you just my mobile app that you can play with afterwards, and you can do all kind of payment calculations. It's got information on there, super easy to use, but y'all can use that if you'd like. So I'll do that after I get done today too. So what we're going to be covering today, we'll cover why do you want to purchase a home. Talking about the pre-qualification versus pre-approval. We'll go over some credit tips. They usually got a lot of questions there about credit. Finding a lender, finding a loan program, like what do you look for, and just the loan process in general, like what you're going to go through when you actually go through this deal. So first, why own a home? If you're renting, you're probably paying somebody else's mortgage, right? The landlord, if he's got it financed, they got to make a payment. You're paying the rent. Hopefully they're making money, right? But you're paying somebody else's mortgage. Right now, still there's some big tax incentives to own a home. There's some tax saving. You can deduct your property taxes, your interest that you pay. All these things are still in the tax code, right? They didn't take it out in the recent deal. So obviously, and the biggest thing, how many in here are renters now? Sort of. So if you've rented for any period of time, like longer than a year or two, your rent's probably gone up at some point, right? So that's the worst thing that can happen is your rent keep going up. So what getting a home on a good 30-year fixed rate mortgage does is it fixes that payment for the life of your loan, which is awesome. And obviously you can build equity in your home. That's one of the easiest ways to build wealth in this country is being a homeowner, because that equity builds up. When you eventually sell it, you get to hopefully keep that money or put it down on another home and keep that. That's how you build wealth for your family long term, is through home ownership. What are some hurdles of renting or home ownership? Sorry. So obviously you have the repairs and maintenance. That's like on you at that point, right? If your heat and air goes bad, you got to fix it. If your water heater busts, you got to get a new one. As a renter, you don't have to deal with that. So you have some decreased mobility. Like you can't just, if you buy a home on 100% financing in January and you got to up and move for a new job in June, that can be problematic to sell it, right, agents? Sometimes it's hard to get out of that in a short time period, right? So buying a home is not for everybody, but it is, if you're planning on being in a place for a year or two, it's generically probably a good investment, right? Obviously the worst case that can happen is you get behind, you lose your job, something you got to foreclose, you got to contend with for the next several years on your credit, right? That's like the worst case scenario. You don't have to deal with that on a rent, but I will say this, I see this a lot too, is if you don't pay your rent, that can also impact your credit just as bad as a foreclosure. It may not impact your ability to buy a home as long again, but it's still an issue if you don't pay your rent. All right, so into pre-qualification and pre-approval. So what is a pre-qualification? That is basically a preliminary approval just based on the information that we get in an application. So like if you were to call our office or apply online, we're taking the information that's given to us and just saying, yeah, credit looks good, this looks good. If all that's accurate, we're good to go. So it's really, really surface level. It don't have a lot of value to it, and lots of surprises can happen. We don't like that. So we encourage, and probably all the agents here will encourage you to get a pre-approval. So what that is, that's based on accurate, true documentation that you've given to us and provided to us. And we're scrubbing that stuff. We verify it, me and my team, and usually run your profile and your credit deal, your loan information through an automated underwriting system. For whatever loan program you're doing, we have an automated system to kind of give us a preliminary approval based on that accurate data. And there's really few things that can go wrong at that point if we've looked at it. And if there is something you need to work on, we tell you. So also our company offers a thing called an advance approval. And what that is, that's really the highest level of approval you can get before you find a property. So what we do is we actually go through some of the loan process that we'll go through later. We do some of the verifications of employment. We check all your assets. We get every explanation that we can, and we send it to our underwriter, who actually is the one signing off on your loan. And they actually say, yes, this loan is, or this profile is conditionally approved for a loan up to this amount of money. That's like, only thing that really can go wrong at that point is something with your appraisal or the title work on your property that you buy. So that's like the best thing you can do if you're looking for a home, is something like where you get fully underwritten. Very few surprises that'll happen at that point. Any questions so far? Cool. Some of the documents that we'll need for like a legit pre-approval, it's going to be your W-2s for the last 2 years, your tax returns for the last 2 years, your 2 most recent pay stubs. Most people get paid every 2 weeks, so we really need pay stubs covering 30 days. For those of you who get paid weekly, we need like your last 4 pay stubs, right? So we just need like a 30-day sample of your earnings. And then your 2 most recent bank statements also. So we look at, when we look at bank statements, we look at stuff like deposits coming in primarily. We don't really look at how you spend your money per se. We're looking for how much money we can verify that you have in your accounts. We also look for deposits where you may have other income that we don't know about, or you may have taken out a loan somewhere, that some unverified loan that you've taken out, some kind of deposit like that. And finally, your photo ID. You know, before we do all that stuff, we got to verify you are who you say you are. So this, I like to show this graphic here. This is like pre-approval is like the pearly gates getting into the home ownership path. You want to do this before you really start shopping for a home. Am I right, agents? This is like one of the first steps you want to do. You know, obviously finding a realtor is going to help you get into the home, but if you can't get through this phase right here, it's really not fun shopping for a home when you find out later that you can't get pre-approved for it, right? So I encourage everybody to do this part first. Any questions on the pre-approval process or what you have to bring?
How long does that take?
Great question. How long does it take? So typically, like just a generic pre-approval I was talking about, we can look at that pay stub and taxes, and usually within a day, you know, depending on what our schedule is like, and we'll say, yeah, all this checks out. We got the income just like we need it, and we can move forward, right?
Go.
And we're good. So unless you do the advance approval, which does take a few more days, right? Because our processor is actually getting all the verifications for employment, send it to an underwriter. It takes them a couple days to get to it. That kind of stuff. That process takes about a week, but that's like fully underwritten, right? So, but a generic pre-approval is also good for about 3 to 4 months, depending on the loan program you're good for. So we don't have to repull credit for like 3 or 4 months through that process. So that's also something to keep in mind. And usually the only thing we ever have to update is just, like, so let's say it takes you a couple months to find a house. All we have to do at that point is just get a more current pay stub and a more current bank statement. And once we've already done the other stuff, we're good. Make sense? Good question. Okay, let's hop into credit. So credit has probably, it garners the most questions that I ever get is dealing with credit, because it's such a huge topic, right? It affects everybody. So I just want to cover some basics. I don't know, you know, what levels knowledge of everybody's at, but I just want to cover some basics. So credit scores, let's talk a little bit about that. So there are 3 major credit bureaus. You have Equifax, Experian, and TransUnion. And these are just some generic score ranges that you can kind of fall into, right? And anybody aware of this stuff so far? So, you know, 720 above, you're usually in pretty good shape for getting approved for almost any loan you apply for, as long as you can pay the money back, right? If your debt ratios are in line and all that stuff. 680 to 719, still good. 620 to 679, sort of average, and that's probably where 75% of our clients fall. I mean, for real, in that 620 to 679 range. And we do loans for those people all day long. So don't think just because you got a low score that you can't buy a home, okay? 619 and below is kind of what factors into the poor category. We see a lot of people in this category as well. And but we will help everybody that comes to our office, you know, and I would say most lenders probably do the same thing. I can't speak for everybody, but I know that we do. So if you're not at that point and there are issues on your credit, we will tell you. We'll say, this is what you need to do. This is the things that I see. And we've worked with countless people to get their scores, you know, up into the category of being able to get approved for a loan and buy a home. And sometimes that happens in 30 days. Sometimes that takes a year. It just depends on how willing that person is to do what we ask them to do, really, at that point. So, but our goal is to help you get a home. Like, we don't want to just turn you down and say, nope, sorry, I can't help you, right? That don't help you. Because there's a lot of bad advice that you can hear from your family or somebody that thinks they know about credit, or you can read about stuff and you'll get all kind of different information. But credit is kind of like going to a doctor and you need a prescription for this thing. Like, it's very, very specific. And we'll go over some generic stuff that you know, can help you get good scores, but Everybody's situation is different. I don't know how to better say it than that. So just cover some credit tips. So if you're looking to buy a home, before you do anything, ask your lender first. Anything with your credit, anything with your finances. Like, I know that sounds sort of like I'm asking dad can I go do this? But like, our goal is, again, to avoid surprises for you, right? Man, I've had, this is just speaking the truth, I've had like 2 or 3 clients in the last 30 to 45 days go make major purchases after we've pre-approved them. Like, I had one client go buy like a $700 or $800 vehicle. I'm like, what are you doing? Right? That's like the worst possible thing they could do. And it almost cost them the home. I mean, like, within a few dollars, almost cost them the home. So always ask. And we'll tell you, do this, that's okay, or don't do that, or wait till we're done, or like, we'll tell you, we'll be honest if it's going to affect you or not. Not everything will kill your deal, but just ask. That's all we can tell you, right? Some other credit tip, work to pay down your revolving balances. So like, if you got credit cards of any shape or form, if you can keep it to 30% of your limit or less. So like, for example, if you have, just for easy math, if you have a $1,000 limit, which may be high for some, if you have a $1,000 limit, you need to keep that balance less than $300 on that credit card. Does that make sense? So 30% of the limit. It's not so much how much you owe on the balance, it's all about percentages. And really, if you can keep it below like 7%, which is extremely low, that's where you kind of get the best bang for your buck, right? If you go up and start making 50%, 75%, or maxing it out, that will kill your credit score, especially if you got very little credit to begin with. All right, don't close accounts. This is sometimes a myth too. Like, people say, well, I'll just close it out. That's not necessarily a good thing. One part of your credit score is your average age of your credit trade lines, right? So if you've had a credit card for a couple years, maybe you got it at Belk or some department store, and you're like, I'll never use that card, I'll just close it. Well, you just lost 2 years of history that's built into your average credit trade line, right? So you had that one that's 2 years, you had this other one that was a year. And so it can mess up your deal. Now, I won't say that that's always a bad thing, but again, it goes back to number one. Before doing anything, just ask your lender, and we'll tell you, is that a good thing to do right now? And we'll tell you, we'll be honest. Keep your hard inquiries for new debt to a minimum. After you get pre-approved, for sure, going applying for any new credit cards or auto loans or installment loans at a bank, all those can be bad. And we say, people ask this all the time, hey, if I go talk to another lender, is that going to kill my score? And just being perfectly honest, no, it won't. Like, if you shop for a mortgage, just like if you're shopping for an auto loan, those mortgage inquiries are sort of grouped together as you're applying for a single loan. Does that make sense? Because the credit bureaus know that you're not going to go get 3 mortgages just because you applied with 3 lenders. Does that make sense? Question?
Please, if you have like 2 or 3 small loans, and you consolidate those into one, and it actually brings the payment lower than it was for all 3, certainly all 3, during the, or like after they have run your credit.
Right.
Is that okay?
It probably goes back again to number one. So it just depends. Sometimes if you're like if you're on that balance of qualifying for a score, sometimes if the program that we're doing requires us to repull a new bureau, just because you've got new debt now that we did not know about before, like a new actual debt, even though your payments are lower, sometimes we have to repull. That's a very specific loan program though. Sometimes we don't, and that actually helps your debt ratio, and it's fine. So I don't want to say a blanket yes, but just ask. Depends on. So, and your lender will know if that's a good idea or not. Based on, they should. I'll say that. Limit disputes. So to truly inaccurate information. So if you've got something inaccurate on your credit, and you see that, like if anybody here use Credit Karma or Credit Says Me or something like that, right? Those are okay. It can help you monitor what's on your credit. But like Credit Karma only gives you 2 bureaus, right? Don't give you all 3. So when you have that, sometimes we pull all 3, so we'll see stuff that you don't know about on this other bureau, right? So, but if you're monitoring that stuff on there and you see something that's inaccurate and you go dispute it, don't just dispute it because it's derogatory. Like if it's a legit collection or if it's a legit late payment, don't dispute it just because, unless you have valid proof that it's wrong, right? You'll get bad advice too. You might read this. Just go dispute everything derogatory and see what falls out in the wash, right? People will tell you that, and I've had people come and tell me that countless times. That's not a great idea, because when we pull your credit and you got like 4 open disputes still that haven't been, carried out, we can't really move forward until those disputes are resolved. So that can delay the process for something that maybe just be accurate already, right? And sometimes having a collection won't kill your opportunity to buy a home, right? Sometimes it's several. We see a lot of medical collections, right? It's just collections that are related to like default on credit cards or a loan, some type of loan, housing, any type of housing payment. Those type of collections are sort of more serious in a lender's eyes. Does that make sense? And everything's, again, case by case. Another thing, back to closing accounts, before you talk to a lender, you may think, I need to pay off all my collections. That may or may not be a good idea. So sometimes that can actually drop your score because that collection could be 3 or 4 years old, and now you've just updated it. Now it's a new paid off derogatory, which you think in your mind that looks good, right? But sometimes that can impact your score in a negative way in the short term. So I say all that to say, just ask. It would be better for us to look at it like where you are now and tell you exactly what you need to do. Because sometimes, yes, you may have to pay those collections off to get a loan, sometimes, but we can do that as a part of our mortgage transaction and it not impact your score that would derail your opportunity to buy a home. Does that make sense? For those of you who don't have a lot of credit, some programs allow us to use alternative credit references for your credit, like stuff that never reports to your credit. So like if you're paying rent now, it probably doesn't report to your credit unless you're renting from some major firm that reports it monthly. It just don't happen very often. But we can get verification of rent from your landlord. You've been there 18 months, you've paid perfect on time, that's great. That's a supplemental credit reference for us. If you have, maybe just one credit card you've had for 6 months and a student loan you've had for 8 months, something like that. Does that make sense? And we can get utility bills and things like that supplement what would never report to your credit, just to show that you can pay obligations on a monthly basis. Any questions on credit before we move on? Just generic questions, fire away. Nothing? And if you think of something, don't do that. So I want to also, if you will, take some of these. I'm going to pass out this book. Super short read, but I partnered with a guy named Doc Compton. He's like, I think I know a lot about credit, but he knows 10 times more than I know about credit. He's really, really good, and he wrote that book, Credit Ready in 5 Simple Steps. It's my gift to you guys today. So, but read it. It's really, really good, and it'll kind of give you some basics more in depth than what we covered today. Is that cool? All right, lenders and loan products. So what about finding a lender? What do you look for? I would say find a lender who's not going to treat you like a transaction, not like a number. You're just one of 1,000 loans they're working on right now, right? And you don't matter. But find one that you can like as a friend, somebody you like, that you trust, and that can be like a long-term relationship, right? It's probably not the only home you'll ever buy. You'll probably sell and buy in another 5 to 7 years on average. So, we want to be that. For us, that's our goal. It's like provide a service that you're welcome to come back anytime. We hope you have a great 5-star experience, right? But if you just call these huge, I don't want to disparage anybody, but like if you call these huge national people, it's just like a numbers game, man. It's just a number. So, but I would say just find somebody, preferably local that you can trust. They know the market, they know the agents, they know the property. and it helps that transaction go smoother for you. And I always like to show this right here. There's always somebody willing to do it cheaper, right? Like I said, you can search the internet, right, for anything and find it cheaper. Okay, I'm just going to be honest. But it is. I've had numerous transactions where somebody called us, hey, our rate's this, our fees are that. They go find it, $8 a month cheaper somewhere else because it's like an eighth in the rate, or their fees are $500 cheaper. Okay, so they save some money, right? And I'm not telling you not to shop. I'm just telling you, you don't always want to go with the cheapest deal, because I had this. It was so funny. I'll just give you an example. Let's tell you a story. This guy was buying a second home. And these are the ones that are probably more sensitive to this stuff. Buying a second home on the lake. He called us and here's what we can do. Blah, 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 blah. This was like November of last year. Yeah, we can do it, and da-da-da. So it rocks on. He calls me like, was it late January? Still had not closed on that home. And his lender had just told him, no, we can't do your loan the way you wanted it. We got to do this. He was not happy, right? So he said, what can you do? So we were able to get him what he wanted. It cost him a little bit more because now rates had actually increased since the first of the year, right? What I could offer him in November was totally different than what I could offer him in late January. So, but he still got the same rate he wanted. He had to pay a little bit more for it, and we closed in like 2 weeks. So like, the point being, sometimes you go with somebody you trust and has a track record of just getting the deal done. You're not going to miss $5, $6, $7 a month, I promise you, and you're probably not going to miss $300 to $500 in cost if you trust somebody to get your deal closed and they've worked with that agent and they've got a good track record of doing that. That's all I'll say about that. So, choosing a loan. This is where you might want to take some notes, because I'll blaze through this stuff pretty fast. And anybody that wants this presentation, I'll be happy to email it to you, okay? So that way you can have it for a record, right? So you want to find a loan that fits your short and long-term goals. Most people are going to go with a 30-year fixed rate mortgage. But sometimes you have a situation where you may want to do something different, and we'll go over those options with you. We present all those different options if you do. Some buyers will qualify for multiple loan products and some won't. And what I mean by that is, somebody might have, let's say for starters, let's talk about how much you have to put down, right? That's one of the things we look at. If you have zero money to put down, there's one or two products we can even look at, right, for you, right? If you have $5,000 to $10,000 or something saved up for a down payment, then we may have multiple options for you to compare. Does that make sense? That's just one aspect. Sometimes it's credit score. Sometimes it's the income debt ratio. And of course, we talk about these things right here. So the things we look at: credit score, your household income. When I say household income, that's whoever's going to live in the house and whoever you're kind of living with, if you're married or if you got a brother that's going to move in with you, that kind of thing. Household income, even though they may not be on the application. And I'll give that distinction, but I hear you.
That's right.
Your debt ratios and the amount of money that you have available for down payment. So these are kind of four basic things that we look at when we're trying to put loan options out there for you, okay? And kind of give you your deal. So we'll talk about conventional loans, okay? And I'll try not to use my mortgage lingo. So if you have questions about what I'm talking about, please stop me and ask, okay? So for these programs, minimum FICO score is 620. I will tell you, most people that have a 620 don't typically end up going conventional unless they're putting a substantial amount of money down, and it just makes sense for them because sometimes the rates are so FICO driven on a conventional loan, it just doesn't make sense to take a much higher rate on a conventional loan when you can get the same thing on something else that may be cheaper. But again, every situation is a little different. 5% down is kind of the generic form that you have to put down on that program. 3% down is available in some cases if your applicant And that, when I say whoever's on the application, if that income meets the criteria for a program called Home Ready, then you might be able to put 3% down on a conventional loan. Okay? There's no household income limit, so again, what I mean by that is everybody that's living in the house, whether they're on application or not, if you earn income, so you got like a husband that works and makes X amount of money, and then you got a wife that's not on the application, but she makes X amount of money too, we have to calculate all that into the household income. Does that make sense? When we're looking and thinking about qualifying you for other products, that's really what I'm talking about. But this one, that household can make $300,000 a year and still qualify for a conventional loan, okay? And still put 3 or 5% down. And then private mortgage insurance, or PMI, anybody ever heard that term? That is required if you're putting less than 20%. And it can be inexpensive the higher your FICO score is. That's another thing that having a good credit score can help. If you're going to go conventional, your rates are better, your private mortgage insurance rates are better, which is part of your monthly payment that you pay. So all that, but that is required in some shape or form. You can pay it monthly, you can pay a one-time thing. There's different ways, there's like 7 different ways I think to do PMI, but I won't get into all that today, but all that being said, it is required if you're putting down less than 20% on a conventional loan. FHA, extremely popular with first-time home buyers. This one also requires a minimum score for 620 for us. I will also put that disclaimer. This is for Willow Bend Mortgage, okay? Some lenders will do them lower than that, okay? 3.5% down payment required on this one, and that's 3.5% of your purchase price. So again, easy math, $100,000 purchase, that's $3,500, okay? No household income limit again. It does have a loan size limit, and here locally it's almost like $300,000 or something. So I mean, it's pretty high and still get an FHA loan. You can use a non-occupant co-mortgager or co-signer. People ask us about that all the time. We got especially young folks with either limited credit history or something like that, or they got 3 months on the job and we don't have stability of income or something like that for somebody, but they got a still decent credit score. Well, we can have mom or grandmom or aunt or uncle, somebody like that that's related to them, co-sign, even though they're not going to occupy the loan or occupy the home, sorry. Does that make sense? So this happens a lot on FHA loans. It does have an upfront and monthly mortgage insurance. So the upfront mortgage insurance is financed into the loan. Almost always, I mean like 99.9% of the time. I don't think I've ever had a client pay that out of pocket, even though they have the opportunity to. Most of the time they'll just finance it. And then the monthly mortgage insurance, it works just like conventional loans. It's paid monthly. And the difference being with mortgage insurance is on a conventional loan, if you have PMI, it will, if you're buying a primary residence, it will eventually fall off once you hit a certain percentage that's your loan to value, what the property is worth versus what you owe. On an FHA loan, unless you're putting down 10%, which again, most people don't. If they're doing FHA, they put down 3.5% or so. This mortgage insurance is for the life of the loan. So it stays on there the entire period that you own, that you have that loan, okay? Not as long as you own the home, because you might refinance it and get out of it. But it does go decreasingly cheaper every single year because it's based on the balance that you owe every year on the kind of like annual basis. And so it does decrease and it will get cheaper and cheaper every year a little bit. So, question?
Exactly what is it for? What does it do?
Yeah, so what, yeah, that's a good question. So what is PMI, monthly mortgage insurance? They all call different things for these programs. But what that is because you're not putting down 20%, the lender is taking a higher risk, right, on that loan of default because you're not putting skin in the game, sort of. So what happens is everybody on an FHA loan or people on a conventional loan pay into that private mortgage insurance or mortgage insurance fund. And if a loan defaults, that lender can apply for recuperation of some of the money that they might lose on selling that home. Right? They had to foreclose, they lose money, sales and foreclosure, they can go back to that mortgage insurance fund and say, hey, we lost $20,000, can we get some of that back? Does that make sense? So it's like a group insurance plan for a default, and everybody pays into it. And it's kind of like health insurance. You're paying a higher premium for some that are more likely to default than some that are not. But it's just kind of part of the deal, right? Does that make sense?
It does.
Cool. USDA or rural development loans. These are very, very, very popular with first-time home buyers. Again, for us, minimum score 620. Here's the reason why they're super popular. No down payment. It's 100% financing, right, on the property. If you're looking in the eligible area, like for us in Coleman, the entire county is eligible. So if you're looking anywhere in Coleman County, it's eligible. If you're looking outside of Coleman County or any other state, then there are areas that will be eligible and areas that are not. And USDA has a website that you can go put in the address and it'll tell you if it's eligible or not. It's based on like a higher population areas, like places like around here, Hartselle, Decatur, Huntsville, those city limit areas sort of are ineligible for that program. If you get down into Gardendale, South, sort of Birmingham, does that make sense? Sort of that area is ineligible in those higher populated areas. So, you know, the rural part, that's where that kind of mindset is. It's lower populated areas. This one does have a maximum household income. So we have a lot of people that want to come in and make decent money, but just don't have a down payment. Sometimes they may make too much money to qualify for this program and they have to go something different, right? That's why we look at that household income. But it's still pretty generous for a household of up to 1 to 4 people. You can still make $78,200 a year combined with whoever makes money in that household. If you got 3 kids or more, or there's 5 or more people, I mean, you can actually make over $100,000 and still qualify for this program. So it's still pretty generous. I will say too, we don't offer the another form of USDA loans is a direct loan, and that's where you go to the local county office or whoever manages that county area. Like for here in Coleman, it's local in Coleman. And if you have a lower income stream, sort of like the I don't want to quote the income numbers because I don't really know them offhand, but if you have a much lower income than this, you know, if it's a household of 1 and you're making like less than 18 grand a year or something like that, 20 grand, we might direct you there anyway. Like if you come to us and say, yeah, you know, we just can't qualify for like much based on your income level. So sometimes we'll direct you there, and sometimes you can get some subsidized rates if you meet that income criteria. And you can really get more house for your money if you meet that deal. This one also, so you cannot own another property. All these other programs, if you had a home to sell and you wanted to buy another home, sometimes you can keep that other home if you hadn't sold it yet, if you can, again, qualify for 2 payments and things like that. But this one will not let you own another property and use USDA to finance another one. So where I see most of the times is somebody that owns some land and got a mobile home or something like that on it, and they want to use USDA to buy another house. What they end up having to do is either probably sell the property, the mobile home, transfer that to somebody else's name, or it has to be an issue where they don't own the property and they just own the mobile home, and maybe it's still not on a permanent foundation. It's still got the axles and the wheels under it and maybe has some skirting around it, so it's still movable. You know what I'm saying? They'll allow for that in there. And then this one does have, again, upfront and monthly mortgage insurance, but it is cheaper, say, comparatively to a US or a FHA loan. So it's about 35% less monthly than an FHA loan, and the upfront mortgage insurance is cheaper as well. So if we're comparing apples and apples and somebody qualifies for an FHA or USDA, almost 9 times out of 10 they're going to pick USDA just because it's cheaper. So
I'm going to be out of questions pretty soon, I promise.
You're good. No, you're good.
If you go through USDA
Mm-hmm.
and the payment is subsidized, if the original buyer were to pass away, what happens to that house?
It would go through the same process, like if like probate and will and who gets it and that kind of thing. If you got an issue where there's no heirs, like USDA will buy that property back and sell it just like any other lender. Is that what you're asking?
Right, but does the subsidy that the original owner, does that have to be repaid by the heirs?
That's a great question that I probably couldn't technically answer if in that situation. Now, if somebody's still alive and they go sell that property, right? There is some potential recapture that if they're making way more money now than they are when they qualified, they can have to pay up to a certain portion of that subsidy back to the USDA. but I do not know how it affects them if the heirs. I don't know. You know, that's a good question though. I can find out and let you know. Almost done here with loan programs. VA loans. Any veterans in the house? Really? This is actually awesome. Yeah. So VA loans is, in my opinion, the best loan on the market, right? It's got competitive rates. It's all these different things. It's flexible on guidelines, all that stuff, just like FHA or the USDA. But again, for us, all these minimum FICO scores are for us. 620 for us. Qualified veterans or active service military. You know, you got to have a VA certificate of eligibility. We can pull that for you as a lender and help you obtain that. No down payment needed. Again, it's a 100% financing program. The cool thing is it does have a VA funding fee. Again, that's basically mortgage insurance of some shape or form. That's upfront, that's financed into your loan, just like all these other programs. But it does have no monthly mortgage insurance, which makes it ultimately the most competitive product that you can get. Because you get 100% financing, you got no monthly PMI or mortgage insurance. Super, super awesome program. And if you got a veteran receiving any type of disability, even if they're getting like $100 a month in disability, there's no upfront mortgage or upfront VA funding fee either. That's typically waived in most cases. And again, when we pull the certificate of eligibility, it'll tell us, are they exempt from that funding fee? So, you know, if you got a disabled veteran of some shape or form, they can buy a $100,000 home, they got a $100,000 loan. Some of these other programs, like if you got a USDA, you get a $100,000 loan. You make your loan amount actually, because of that upfront fee, it's like $101,000 and some change, right? Your actual loan amount. So, awesome program. If you know a veteran, always recommend this first. If for some reason they can't qualify for that, we can put them somewhere else. Down payment assistance. A lot of people like that maybe don't qualify for USDA because of their income or for some other reason, from like an underwriting standpoint, their credit history, or some reason they wouldn't qualify for USDA. We look at some of these down payment assistance, and Alabama Housing offers one here in Alabama called a step-up loan, and it's a modified FHA loan or conventional loan. So basically, you're getting a first mortgage through FHA or a conventional loan. Okay. And both those require down payments. Remember that, right? FHA is 3.5%. Conventional can be as low as 3%. So what happens is they give you a 3% second mortgage to help with that down payment requirement. Does that make sense? So again, easy math. Try to go easy math. $100,000 purchase price. If you're doing an FHA loan, you would have to bring 3.5%, which would be $3,500, right? If you qualify for this program, they will loan you 3% or $3,000 toward that $3,500, right? So you only had to bring $500, kind of as far as the down payment, right? So you'd have to bring the $500, but it's better than $3,500, right? So this is a good program for that. This does have a household income limit that works just like USDA. We have to use all the people that make money in that household, and it's $97,300. To my knowledge, they haven't updated that. I'm not aware of it, but that's kind of where that falls, whether you have one person in your household or 20. It's the same number. It doesn't fluctuate like USDA. Any questions about that? And I talked about FHA. You can do the same thing with a conventional loan. Like if you got qualified for a 3% conventional loan down, you can get the 3% down payment assistance, and it kind of works out like 100% in that case, as far as the purchase price goes. And what that second mortgage is, they give you the same rate as your first mortgage, and it's on a 10-year loan. So it's, instead of having a 30-year second mortgage, you get a 10-year second mortgage. And a lot of people, honestly, what they do is they'll get their tax refund back and pay off that little small debt, and then their house payment goes down by $30-40 just like that. So it's kind of like, you know, that's a lot of times how people do it. We also offer renovation loans. The minimum FICO score for us for this program is 640. Steps up a little bit. And I won't get into a lot of details about these things unless y'all have questions, but essentially FHA and conventional have these different types of loans. It's called a 2 or 3K. They got two different versions of that called a standard and a limited. Fannie Mae or conventional loans offer the home style loan. And both of these, essentially allow you to finance repairs. Like, so if you find a property that you like the location, but you don't like the exterior of the home, right? You want to get new siding, or needs a new roof, or maybe everything's in good shape. You just want to update all the paint and the flooring, right? This is like HGT in real life, HGTV in the real life. So you see the Flip This House, or what, Fixer Upper, those types of programs. Anybody watch those? You can do this in real life. And this is sometimes maybe how people are doing it. I don't know if they're paying cash or whatever, but these types of loans allow you to do those types of renovations and finance that cost in, right? So again, I'll just give you an example, easy math. If you got a $80,000 home, right, because you get it cheaper because it's outdated, and you want to do $20,000 in repairs to that home, and maybe you're doing an FHA 203K loan, then you take the $80,000 purchase price, you're going to have $20,000 in renovations. Again, you're at that magic $100,000 number. You would still pay 3.5% of the $100,000 instead of the 80, right, on an FHA loan. But it still allows you to hypothetically do all your repairs in there. So it's awesome. We've done a lot of these lately because the inventory is so tight, nationally, locally for sure. And sometimes you like the location, you're gonna have to settle for that property that maybe it's not got everything you want, but you can do something like this and get what you want. Does that make sense? Because you're just not waiting for that other house just to hit the market. And go ahead and do the process. Awesome. Any questions about products? I know that was really, really fast, but any questions?
I have a question.
Yep.
So on the USDA loan, for example, I have a house and I'm thinking about selling it.
Okay.
And I want a USDA loan. Can I, if I sell my house,
Can you
I then turn around and buy a house while that one's, say, under contract, and go and buy that house under a USDA? Would I qualify?
Absolutely. As long as you close on that one before you buy the other one.
Okay, yeah.
And it can be the same day. It's just one of the requirements is we'd have to get a proof that you sold the other home, and you only got one home now, but yeah.
I have one more question. Back to the beginning.
You're good.
You had said that, if people are shopping for lenders, is there not a certain period of time, and I don't know, I'm asking, is there a certain period of time, say, I go to you, and then I go to Quicken, and I go somewhere else, and then I decide, well, I really don't know if I'm ready to pull the trigger.
Yeah.
And then I hear of another lender, say, in 3 weeks, and I go and apply with them.
Yep.
Is that going to be in the
Same wheelhouse?
Yeah.
They haven't ever published the actual time frames that you have to shop, but it's roughly between 30 to 45 days as far as a window of time. That's roughly.
I have a lot of clients ask that, and I need to,
And he was like, well, yeah.
Yeah.
And it's one of those things, like if they were marginal on their credit score, it can be a factor. If they wait 2 months, it's going to show up sort of like a new set of, you kind of open a new window of inquiry period, right, for a mortgage. But most times if you're shopping in that, unless something materially changes in your credit, because every lender is pulling a new credit report, right? So we've had that happen. So they pulled it somewhere else. They had a 640. We pull it a week later. They had some medical collection hit. Now we got a 580. Like, well, I thought they would. It's not the inquiry. It's like something materially changed in your report. So that window of time kind of reopens after you. 30 days is safe. 45 is probably pushing it, just because so many things can change in somebody's credit. So, any other questions? We're almost done.
Question. I spoke with a lender earlier on, and they mentioned that there were some home repairs that need to be done. And needed is the word that
Like required?
I spoke to. Yeah. That they could give you a $5,000 grant. This is money that didn't have to be paid back, per se. But that those repairs had to be done within 1 week. Are you aware of that?
I'm not aware of any grants, especially locally. Any kind of grant would come from some sort of local government, municipality type thing. Now, unless this was, miscommunicated in some way. So, whoa, kind of tripped at me.
I don't have a remote.
FHA and some of these other programs can allow for what's called a repair escrow, where these kind of minor required repairs, and we do these too, to where you can finance that in sometimes.
Finance it in. Okay.
So I don't know about any grants that like you got to get a week to get done, But most of them are like if you qualify for a grant, then you can qualify for a grant. It can be used toward down payment or whatever, right? Closing costs or repairs or whatever. But if it's a legit repair escrow, most of the times it can be financed in if the value is there. Some people won't tell you that either. But like if you're buying it for $100,000 and it appraises for $100,000 and you need some repairs, we can do repair escrow, but you can't finance it in above the purchase price. That's another little tidbit of info that you need to know. But if it does appraise for 102 or 103, and sometimes that happens too, it appraises for a little bit more than what you're buying it for, then you can roll it up and cover that in for repairs. So, any other questions? Good question. Cool, we're almost done. The loan process. So kind of what happens when you get pre-approved, you go find a home, kind of what that process looks like. So and we'll blaze through this. So step one, you're going to sign the forms associated with the property that you're about to purchase and the loan so you're going to sign the contract with your agent. You're going to, once we get that contract, we're going to prepare all your loan paperwork. We'll have specific for that loan program, for this property, for this loan amount, this rate, this payment. We'll send it out to you, electronically. You can sign it, or you can come in our office and sign it, whatever. But you're going to have to either set a meeting or do this online and sign all the paperwork, right? Step two, you're going to provide your most current updated documentation. Like, so if we pre-approved you, like I said, 45 days ago, we're going to have the most current pay stubs that you got and the most current bank statements that you've got. Even though the pre-approval was good, we always had the most current income and asset that you have. So once we get all that stuff in, myself or somebody on my team or somebody else is going to submit it to a processor. Okay? And it goes to processing. What happens there? They start ordering verification of employments and your assets. They're looking over all your documentation that hopefully we've already seen, but sometimes people, they'll go through the typical pre-qualification process and we say, yeah, you look good. I mean, if you make what you say that you make, you should be okay. And then sometimes we find surprises, sometimes we don't. If they say, I'll make $15 an hour or whatever it is, and sometimes they work out and they make $15 an hour. Sometimes they tell us they make $40,000 a year, but we find out $15,000 of that's overtime and we can't use it. So that's some of the things that we see surprises on if we can't look at your documentation ahead of time. But they look over all this stuff and they order all those verifications, sometimes of verifications of your debt and things like that. Then we're going to order the appraisal and the title work. Typically that takes about 5 to 7 business days to get it back. And while we're doing all this, kind of this is going on too. Then you're going, if you hadn't already talked to an insurance agent, which you'll hear from today too, you're going to get a homeowner's insurance, usually a quote up front. They're not going to bind coverage probably that early in the process. But you get a quote and say, oh, it's going to be $800 a year for this property or whatever it is. And we need that usually before it goes to underwriting, so we'll kind of know what your actual payment's going to be. Step 7, once the processor looks at it, she may see some stuff that we need to get before it goes to underwriting. So we may reach back out to you and say, hey, we need A, B, C before it goes to the underwriter, and we'll get that from you. Sometimes it's like an explanation on a deposit, right, on your new bank statement that we hadn't seen yet, or whatever. I'm just kind of giving you some ideas. So then it goes to an underwriting. So it's submitted to an underwriting queue that our underwriters are looking at. It takes 1 to 2 days to get typically what we hope is a conditional loan approval. And when that happens, the underwriters looked over every single bit of your documentation. Hopefully we've caught most of it, but eventually they're going to find something, right? That's why they're underwriters. That's what they're paid to do, is to find all the nitpicky stuff to make sure it meets the program guidelines, and we got every piece of paper that we need to meet that guideline. So we're going to answer any questions they have for us, collect any further documentation that we need from you guys, needed for your final approval. Hopefully by this time we get your appraisal, your title work back. All this is coming together. We get your homeowner insurance agent. We'll say, hey, we're going to close on this date. We need a declarations page or evidence of insurance for this date, and we start wrapping it all up. And all this is taking, let me rephrase. All this is taking, it sounds like it takes like a week to get this done, right? This takes about, on average, 30 days to go from step 1 all the way to the end. Sometimes it takes a little longer, but on average, about 30 days. Next step, final approvals are given from the underwriter. They checked all the stuff we sent back into them. They give what's called a clear to close. That's like the magic happy words for us in the real estate industry. It means you're good to go. So the loan documents the final loan documents are prepared. So all the stuff you're going to sign at closing. We'll send it to the title company. You'll receive a copy of your preliminary closing disclosure, which kind of breaks down, here's your final payment. This is what you got to bring to closing, or maybe you don't have to bring anything to closing. All your fees are finalized, all that stuff, and just you got to have 3 days prior to closing. Now, thanks to some legislation, which is good. It's not a bad thing, but we've got a plan for it. But we got to get it to you 3 days prior to closing to let you look over it. Final step, you're going to attend your closing. You're going to bring cashier's check, or you're going to wire the money in if you have to bring any kind of money. And they'll talk about some of that stuff, maybe. And you're going to bring your photo ID, and you're going to get to work on some paperwork, right? You're going to be like signing what's going to feel like your life away. But you'll sign, 30 to 40 pieces of paper again. It's all the final numbers, all the final loan documents that you signed preliminary up front with us. And then the fun part, when it's all said and done, you get the deed and the keys to your home, and hopefully that's when you get to move in, right? That's the fun part, right? So that's a very quick overview of what happens in that loan process. Just kind of, again, that takes about 30 days on average to go from start to finish. Unless somebody has done what we talked about earlier, that advanced approval, where an underwriter has kind of scrubbed your file from top to bottom, where they kind of do, if I can go back here, I'll get it to go right here. Come on. Right here, this underwriting part. And during the advanced approval process, we're submitting all your stuff, and we're kind of skipping to step 8. We're going like 4, 5, 6, 7, 8. We're doing it a little early. So if you do that process, which we encourage a lot of people to do, it can cut some time off the amount of time you have to wait to close on a home by probably up to 2 weeks. So sometimes if we've done this thing in advance, all we do is get an updated pay stub and a bank statement. We ordered appraisal and title work, and we're waiting on that stuff to come back in. It takes about a week and a half. And then we get the underwriter's already asked for what we need from you. We send all that back up, and they give our clear to close. And you skip like 2 weeks in the process, which is really awesome. So I just want to throw that out there. That's one of the benefits of advanced approval. So I'm done. I need some water. But any other questions whatsoever about anything we've talked about? From my perspective, at least.
Can they go on and apply online on your website instead of maybe coming in?
Yeah, we're flexible, man. They can go online. They can, signamortgageteam.com or whatever. For me, like, I do have an app. Yep, which I'll share with all you guys. You can apply right from the app. But whatever, like phone, if that's cool. If you want to come in and like sit down with a human, that's cool. But 24/7, obviously, you can do it online just like anybody else, right? I'm big on social media stuff. If you're on social media, please find me and connect with me there. And for disclosure purposes, I'll throw this up here. It's got all my final stuff that I have to put up there. But did I put any cards out? I don't think I did. But what I'll do is pass these out too, if you don't mind. Here, these are another little resource I'll give you, some do's and don'ts, and again, everything is specific to your process. But you can take one of these. You may get a lot of paperwork today, so I'm gonna give you these folders. So yeah, thank you guys for letting me talk to you for a little bit. We'll take a 5-minute break. If you need to go restroom, grab a snack or water, and then we'll bring up Randy.
Yep.
Randy's gonna talk about real estate stuff. So thank you guys. Yeah. Stop this thing.
Okay.